Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, welcome.
Always glad to be here.
Joining us from an undisclosed location, not the desk we're used to.
Yeah.
Thanks for doing this. Thanks for making arrangements to be here. We've got some great guests. First of all, our guest today is Mr. David Macchia, retirement income entrepreneur, founder of Well2K Inc., and author of The Constrained Investor and Lucky Retiree. He's also an active participant in many of our very opinionated conversations on LinkedIn. And joins us today as guest host, and you're almost a standing regular guest host, Mr. Bruno Caron, Associate Director of AM Best and author of Lifetime Income Retired Strength. I think I butchered the title, Bruno.
Yeah, it's fine. Close enough.
Okay. Yeah, so Bruno, welcome. Do you want to, first of all, tell us what you're working, what are you doing these days, and then why don't you kick the discussion off?
Well, no, thank you, and very happy to be here. Obviously, very busy with my with my day job, and very happy to be here and welcome David to the show. David, again, thank you for coming. Read your two books with a lot of passion, a lot of enthusiasm. There's definitely an element that you underscore that is absolutely imperative for retirees, an issue that many Nobel Prize winners have discussed and wrote about, and that's income, and the importance of income in retirement. Can you please expand a little bit on how you talk about income in your two books?
Sure, Bruno. And thanks guys for having me. So for me, the way I think about it is income is everything for a retiree. I was at a meeting and I heard Bob Merton, the Nobel Prize winner, say that in retirement it's your income, not your wealth, that builds your stability. And that simple sounding sentence had a really big impact. It kind of drove a lot of my thinking for a long time. And that's what really led to the development of the constrained investment concept, which is really seeking to assess the client's needs in such a way so that at the end of the day, their income is certain or assured. Because obviously no one knows how long they're going to live, and no matter how long a retiree is, they need income. It's the one thing that's they need to maintain the standard of living as best they can. For me, again, it's all about income.
That's we can never say that too much about that. And you develop a model. And what I personally love about this model is the simplistic aspect of it. It's to the point, and you don't need too much research. You don't need a computer. You don't need PhDs in statistics to understand. It's a very simplistic way to know and to gauge and to measure that income. And that's the income to asset ratio. Can you expand a little bit on that method and on that approach to measure?
Sure,
income?
Of course. So, I'm always seeking to decomplicate things because I think we're in an industry that seeks to complicate too often. So, getting away from the jargon and getting something that's very simple that people can understand quickly and easily, I think builds confidence, and confidence is essential in this retiree planning field. So anyway, the idea is that in our industry historically, we've created these wealth circles, right? We put people in these neat little categories, mass market, high net worth, etc. And it's okay, it's great when they accumulate. But when you get to retirement, it becomes very inadequate. So the constrained investor concept, which I'm going to lead to the income assets ratio in a second, says that there are three categories. There are underfunded, overfunded constrained. And the They're underfunded. They have very little capital at retirement. They're going to rely on Social Security. The other end of the spectrum are the overfunded investors. They're a lucky minority that have way more cash than they're looking for. And then there's everybody else. And those are the constrained investors. Constrained investors arrive at retirement with income, with capital, which is great. But the amount of money they have, although it may be large, in terms of its relationship to the income that they need to provide themselves to have at least a minimally acceptable lifestyle, it's not high. So they have to be very, very careful. Right? They have to be careful to avoid investment losses, bad investment decision making, because they don't have the capital cushion to absorb it. If they need to be consistent investors over a long period of time, so they need a framework that encourages investment discipline. Their assets have to be either a certain way. In risk mitigation is the number one priority. They have to be protected against timing risk and longevity risk. Annuities are essential for a constrained investor. And so what happens is that we get to the point where we do the income to assets ratio calculation, which is very simple. It's the amount of income that they absolutely have to have on an annual basis divided by the assets available to produce it. And if that simple division yields a result of 3% or more, they're constrained investors. And once we know they're constrained investors, then we have to then limit to do it. Again, it seeks risk mitigation as the number one framework.
So is being constrained a financial fact, or is it really a state of mind? Like, how do I want to live in retirement? That change my maybe need to shift my perspective on what I'm doing in retirement.
That's a great question, Paul, because sometimes people have unrealistic assumptions about the income they can yield from their assets. But for me, it really is both. It's practical in the sense that there's only so much that we can get from an asset pool in terms of income creation and being reasonable, right? And when they're in that constrained status, I can't say it often enough, they have to be concerned about risk mitigation, which is why I'm on the warpath against the systematic withdrawal of constrained investments. Because it doesn't have the risk mitigation features that they need. It doesn't have the behavioral features. It doesn't promote good investing behavior. The markets go rough. We're about to enter a period, I believe, which is going to be very notable for its focus on mitigating risks. Because I think we've turned the corner. The 14-year engineered bull market is over, it seems. And therefore, there's a lot of people of color. There's millions of people in the United States who are in the wrong income strategy because they've been seduced into it by advisors who think that markets only go up. And there's going to be a lot of financial carnage, and there's going to be a lot of degrading of people's standards of living on any basis because they have the wrong income strategy. Yet the irony about all this is it's very simple to have an income strategy that protects against risks.
So David, as you take your journey and you talk to, I assume you talk to individuals, you talk to advisors. How have you dealt with the inherent resistance that comes up? It's very interesting to hear you say that we're at a turning point, and the reality is, we may be at a turning point in terms of what kind of income strategy the market can support, but the world may not realize it yet. So we all still sort of encounter this resistance as we talk about a different way to look at things. Like, tell us a little bit about that journey and the conversations you've had to have and where they've been successful.
Sure. Ramsey, it's an endless battle for me. Yeah. If you just look at the RIA channel, which is the fastest growing, most dynamic, and it's the most sought after by product manufacturers of all stripes. I did a presentation recently at the Advisor Perspective Summit, and part of that was an analysis of RIA websites. I went on a nationwide search for retirement income in the RIA community. Mm-hmm. And the way I did it is I assessed 50 RIA websites, big firms, small firms, cross-section of firms. And guess what? 50 websites, which is the front door of a business. You're telling the general public, what do I do? This is what I do.
Yeah.
Would you believe that there are 2 words, retirement income, that weren't found at all on 50 websites?
Wow. Or anything equivalent to it?
No. There's a lot of financial planning references, right? But you can't find the two words retirement income.
Yeah.
You know why? Because the RIAs aren't in the business of retirement income. They're in the business of reverse dollar cost averaging. Mm-hmm. And that is not retirement income planning. And that is going to cost the RIA channel potentially a great deal of grief if we have a market that kind of operates in a normal manner, if we get back to that. Recency bias is a very powerful thing. People's memories are prejudiced. They tend to focus on the recent past and then forget the further past. And it's a constant battle because they think that the market returns solve everything. And of course, we know that's not true.
Okay, well, let's double click even deeper into what it means to be constrained. So we talked about it. So I'm going to sound smarter than I am. So let's see. Women live 5 years longer than men, and according to my Google search, I think the women make, I think today, 2022, 82 cents on the dollar that men make. Okay, where do they fit in this constraint? In your spectrum of constraints.
I just created a video called The Great Mismatch. And the Great Mismatch is, the male advisor and the female client. There's a reason that 7 out of 10 incumbent male advisors are fired by the widow within 12 months of the husband passing. That's a huge problem. It's a problem. Men need to be better at relating to women. Now, if you look at the research, and because at my company, Wealth UK, we introduced the first retirement income planning platform developed expressly for boomer women about 4 months ago. It's called Women in Income. The run-up to building that required us to go into a lot of research. And here's what research reveals. There's 3 themes that run through the research. I don't care what report you realize, what you read. It's goals, risk reduction, and conflict. Those are the 3 major issues of concern to the women investor, at least the boomer women investor. Well, guess what? That doesn't match up with what a lot of advisors offer. So I go so far as to say that within 5 years, unless a male advisor can relate successfully and work successfully with a boomer female, there's no chance of survival because the boomer women will control virtually all of the available wealth assets. That's the great mismatch.
That's a big statement, right?
I believe it.
Yeah.
I believe it. And I think logic dictates it's correct, Ramsey, because if you can't relate to the person who's got the pot of money, you can't work with the money.
So you sold me, David. How do I have to change how I behave? I was great with Ramsey. How do I adapt to his wife?
Yeah. So the research also reveals, guys, that men are almost universally focused, almost 100% on ROI. Growth and yield and track records and stock picking, that's what appeals to us. Women are not concerned with that. Women are concerned with the attainment of goals. They're concerned with their values being understood. They're concerned about having an authentic relationship with an advisor. They're concerned about being listened to. They're concerned about their values. They're much smarter than us. They're much more intelligent and solid. And men are going to have to understand that, And the way I sort of bottom line it, where men are concerned about ROI, women are concerned about ROR, return on relationship. They want an authentic relationship with an advisor, and guess what? A male advisor is fine. It doesn't have to be a female that they're looking for. They're very happy with a male advisor so long as that relationship is authentic and they're being listened to and their goals and objectives and values are understood.
So how is that resonating with the various audiences that you speak to?
Incredibly well. I mean, it's really interesting because I live it every day, and I've been so immersed in this subject for a while. But it's like a big revelation for most people to understand this. They don't quite get it, and it's important that everybody gets it. And I think as over the next couple of years there'll be a major there'll be a major dawning on people that they have to view what's important, to the female investor as a big priority, because again, they're going to control all the money.
So as people know, I work for an insurance company. We develop these indices, we put them in, we try to get ahead of the markets. We did a survey of what would be the next series of indices you'd want to see in here. We put ESG in there. Now, David, probably 80% of our respondents were male advisors. And I'll tell you, ESG was it was nowhere near the top based on what you'd expect from the press. You talked about ROR. Is ESG going to be something that's more important for women than men, or is it more personal values they're concerned about?
I think it's... Listen, if you don't know her first name for her kids, you have no chance. So it's turning the focus. I believe it's more personal. I believe it's the personal relationship, the personal communications between the two individuals that will drive everything. And I think the priorities, with some women, it may be ESG oriented. I really don't know enough about it to tell you. I do feel confident in telling you that you need to know about my family. You really need to understand my kids, what their needs are, and that's what an intimate relationship involves in terms of what the woman is looking for. It's so much more than... If you interview these women who fired the male advisor, very often the reason they will do this, he was focused on the charts and graphs and numbers, and I never felt that I was heard with him. I never felt that I was listened to. That's the problem we have to fix.
So I'm wondering, where are they going to find their new advisors? So in your studies, if you hear about people that have let their former advisor go, do we know where they're going? Are they abandoning financial advisors altogether, or do you think they've been successful in finding ones that more address those needs you've outlined?
Yeah, it's a great question, Randy. They're not abandoning financial advisors. The first thing, there's two things that happen. The first thing is they ask their friends, do you have a financial advisor that you're comfortable with? When women will speak to their female friends. Second thing they do is they go to Google and they look at websites and they try to see if there's any messaging that captures them, which is why I'm so frustrated about the RIA websites, because it's like this is where people are going to go to learn about you. You don't even mention that you have retirement income. You don't even know it's a specialty. It's surreal, but that's the reality that we have today.
So what are your thoughts
in terms of
go ahead,
annuity,
Bruno, go ahead.
So in terms of annuities, you mentioned that annuities can fit, can complement very well a plan for retirees. Can you explain exactly how? Like, what's the thought process behind looking at the granularity of income and where those products can fit in to fill the gap?
It's very fundamental to the constrained investor process, because one of the theses or founding principles is that you have to protect someone's longevity. Again, the idea that no retiree stops needing income. So if you've got a female client, for example, who knows something about living a long time in retirement because her mom lived to 96, right? Is it possible that client could outlive her mom by 6 years, say? Well, of course it is, right? With the medical technologies that's advancing, nanomedicine, and smart pacemakers, and all of this stuff that they're working on. If she outlives her mom by 6 years, she's going to need income to 102. Let's say she's 66 today. That's 432 months, 3.5 decades of needing income. There is only one vehicle on God's green earth that will make certain that happens, and that's an annuity. Apart from Social Security, which is nothing but a big annuity system, right? It's an annuity. It's essential, and this is what I tell the RIAs. You're not living up to your fiduciary responsibility if you fail to recommend lifetime guaranteed income to a constrained investor, because your fiduciary duty has two components to it. It has loyalty and it has competence. Competence, which I think of being, like a prudent expert. How can you be a prudent expert and ignore the biggest risk facing the client?
Well,
I don't think you can.
I think it's because the accepted practice is that it doesn't have to. That's sort of the odd thing about how we just the term fiduciary is it still actually seems to sort of fall under the sort of accepted practice that excludes some really important answers and discussions.
Yeah, you're absolutely right. That's a very practical analysis of what's happening. But it doesn't really... it's an interesting discussion someday if you have 4 hours. Why does that situation exist? When I went into the insurance industry 40 years ago, the insurance industry was the custodian of pensions. It was, compared to the asset management industry, way up here, and the asset management industry was way down there. And the whole thing is reversed over the course of my career, right? And at the end of the day, I think it comes down to the world's greatest failure of communications. The insurance industry has not been able to describe its own value to the American public. And part of that reason is the complexity that we addressed briefly earlier. There's a lot of reasons for it, but you're right, Ramsey. That's the sort of status quo, and we have to break the status quo.
So, which annuities? So, there are a lot of annuities. There are lots of different types. I see Bruno nodding his head because we talk about this a lot. There are lots of different types of annuities. Arguably, a lot of them are perhaps chasing that asset management, right? That asset management rabbit, if you will, are in many ways more accumulation tools than decumulation tools. So I'm just curious of the wide array of annuities that are available. Do you have any personal preferences? Like, so if you're going to an RIA and you're trying to convince he or she or him or her to adopt an annuity, which ones do you tend to focus on for those discussions?
In February, I wrote an article which got a fair amount of attention in the industry. It's called "The Trial of Ken Fisher for Crimes Against Annuities." And I said in that article, by the way, I couldn't have written that article were it not for constrained investing. There was no framework available to me to show how inappropriate it is to avoid annuities without that framework. Right? Otherwise, I'd just be name calling. Wouldn't have worked. So, for me, the issue is annuities have transformed to accommodate the RIA. For a long time, the industry was saying, RIA, come and love my annuities. And they wouldn't. Now, every disparagement, insult, prejudice against annuities that RIAs had is moot because the costs have been extracted, the surrender charges have been taken away, the annuities have been created in such a way that they conform to the RIA's practice model, philosophy, and worldview, right? They show up in the portfolio, in the portfolio management system, they wrap fees around them, whatever they want to do. So that part of it has been fixed. In terms of which precise contract type, for me, my main focus is longevity protection, lifetime guaranteed income. So I'm not so much taking the position that it should be this one or that one. It's, for me, any annuity with good lifetime income benefits is like a nurse with triage in an emergency room. Just get one. Get the bandage on the wound, right? We've got to get an annuity in that person's life to protect their longevity. And I don't really spend a lot of time, Ramsey, trying to figure out precisely which is the best category necessarily. As long as it has a strong income component, it's fine by me.
Got it. Okay.
Can I add to that page 61 of Constraint Investor? And I thought that passage really caught my attention because I think that's so true. And it says annuities remind me of politics. And when I think about both annuities and politics, I think there's a great parallel to be made where people seek headlines, people seek titles, people seek to understand the entire universe with 2 or 3 catchphrases. And we all know that the world is significantly more complex than headlines, both politics and annuities. The nuances, the complexities are far more complex than dumbing things down to a few catchphrases. And especially with politics, I catch myself getting out of discussions just because I know you just won't get the right points, the right nuances, and that the situation is a little more complex. And I think that annuities are a little like that. People try to categorize them, one way or the other. Annuities are expensive, annuities are good, annuities are bad, and the reality is that they are very complex, very different. Many are used for different purposes, different points in time, and I don't think that we can just make a blunt statement of annuities are this or annuities are that.
I love that point, Bruno, and I'm going to tell you where this really comes all to bear immediately is writing a Google ad to get people to click to go to an annuity site. You almost have to write Google haiku, right? You have all these limited characters, limited word. David, you've probably done this, tried to work through this. Try to explain this concept within, this, you talk about politics. I could say it's think about this attention economy. You have 25, everybody's communicating everything in 49 characters. Oh, and by the way, David, I have to use words which are past compliance muster. It's hard, Bruno. It's really hard. Protected income. How many? That's like fills up this much. Spaces out the top of the screen.
well, Paul, you're not just competing with other sources of financial advice or financial services. You're also competing with Kim Kardashian and Elon Musk and everybody else that's taking up all that mind share. It's hard. Yeah.
Right. It's easier to say, David, don't trust annuities. It's easier to put that on a Google ad.
That's right. You're right, and it's so unfair, and we're so polarized, because there's financial incentives in maintaining your polarized view. Right? No one is necessarily pure in this regard, and the RIA community has a very polarized view, and yet they can be very much critiqued for their monetary model, right? In certain situations, so we have to try to find. Bruno said it very well. True communication and true understanding is very difficult today, right? And it's certainly that way in politics. And you can't let the annuity business slip into, that. Certainly to that extent, it will not be good for the consumer if that happens.
Yeah. Well, maybe I can just, Ramsey, if you'll go with me on this one, I'll kind of go for a lightning round of some questions here, since we got 2 great experts in this field here today. Sometimes, the simplest questions are the hardest ones to answer. I actually got this question from somebody a couple of days ago, which was really good. He said, can you give me 1 or 2 signs that a person isn't financially ready to retire yet? Wow. So it's financial, like, David, you think of these constrained investors, now I'm putting you on the spot. I had to stop and think. This probably took me 30 minutes to come up with some like button-down answer. I mean, David, Bruno, what would you say? Like, Paul, I think about, it's like politics. I think about the election, maybe I think about these elections on average 10 minutes a year, right? That's probably the real, like, you to use your politics analogy. I don't know. It's probably half that for retirement planning. Am I ready or not? Like, is there anything that says don't do it? Now, David, go ahead, Bruno.
No, I would say the best, and that's not always feasible, but the best way to do it is to actually, a few years before retirement, trying to live as if you are, financially speaking, as if you are in retirement, and looking at your assets, looking at the income they generate, and see if that's a viable plan. And that could be a wake-up call. That's just saying that you can just take 1 year more salary and just add more either assets or generate more income one way or the other, or delay Social Security. All of these things that can help you gauge what the retirement dynamic. So that could be a wake up call if that's feasible, and then it becomes a trade off. Do I want to? Do I like to work? Do I hate to work? Do I need? And then you can start asking yourself the right questions. But it's not, to David's point, it's not about just an amount of asset. I have X. This is it. You really have to go through the dynamics and the actual mechanics and the exercise, and trying to go through a live exercise is I think is the best way to approach it.
David, I love your 3% rule. I think that's a good one. Is there anything before I do the math? I mean, that takes a lot of work for me to add up my income statement and my expenses. Are there any pre-warning signs that I'm not ready?
That's a great question. I think the warning sign is everywhere. Let me give an example. My mother is from an extremely large family, one of 14 children. Growing up, I had lots of uncles around. I had uncles who retired at 53, 55. We don't see that anymore. What we see is people working, not stopping work, right? I think that's part of the answer. I mean, if people felt that they truly were prepared for retirement and could sustain a lifestyle, they wouldn't be so much concerned about working as much as they are. Very few people are in that position where they just have a surplus, and it's going to be very easy for them. But what I would say is, I think getting them to understand their expenses, right, their essential expenses, and then the way I describe it is, try to find what the cost will be to support a minimally acceptable lifestyle. And you can do that very simply. You can take your vital or essential expenses and gross it up by 30%, and then you have to figure out through the income to assets ratio where you are. And if you're at 3% or more, which is going to be most people, it means being really careful on how you're going to be investing your money, and perhaps even continuing to work at least part-time.
Ramsey, do you have?
Yeah, I mean, So just really liked both Bruno's and David's comments on this. I share this view that it's really about sources and uses, and when you asked the question, Paul, the first thing that came to mind was, well, it's the expense part. To me, the first sign that people aren't ready for retirement is they don't know what their expenses are going to be in retirement. And so I thought that Bruno's notion of a live fire test, I think, is a really good one. It's interesting that we had the father of the 4% rule on this show not long ago, and the single most important takeaway from that was his commitment to expense management.
Yes.
Which never comes up. Nobody ever talks about that, right? Everybody talks about the 4% rule. It's sort of like a default, set it and forget it. But nobody really talks about the importance of expense flexibility. And so both, David and Bruno, you both have addressed this. And then David, you use the term minimum acceptability. I think that's something people really have to get their heads around, because people don't always know what that is. Or people are used to sort of a certain lifestyle, but they really have to drill down and figure out what that minimum acceptability is, and maybe test it the way that Bruno has.
Yeah, it's interesting you say that, because right now we're building a calculator for precisely this point, where people can indicate their vital expenses and then gross it up and find that minimally acceptable lifestyle. number. You have to make that easier for them to do that. You're right.
Well, you can grade my answer, and I tell you, I thought about this for a little bit of time. Was do you have a rainy day fund to cover your expenses for maybe 3 to 6 months? Because all the studies I've seen show that your expenses, to Ramsey's point, are typically higher in those first 5 years of retirement than they are afterwards. So you have enough to pushing for surprises. The other one we haven't talked about is healthcare. And I thought, if I'm in my 60s, I'm working, do I have any big medical procedures coming up? Are there things, because man, the minute you get off that employer health plan, now I've got to deal with Medicare supplement insurance, or in terms of a Medicare Advantage piece. Where does healthcare fit, David, in your constrained investor framework?
It's a huge issue. It's a huge issue, and it's hard to predict. Last evening, my mother-in-law fell down. She's hospitalized right now, and she'll have surgery today, and she's going to have a long rehabilitation hospital stay. That's going to imply costs that she wouldn't have predicted 24 hours ago, right? It's a very difficult thing to plan for. I think one of the good developments in the industry is that we have policies like life insurance policies with very generous living benefits that can help defray these expenses when they come up. And advisors really need to be thinking about utilizing contracts like that to help build in that floor of protection for people.
And I think that on the healthcare, I think the income argument also applies. And obviously, all else being equal, a person that will live a very short retirement will have, all else being equal, a shorter amount of medical expenses, and vice versa. So the more income you have, the more you can absorb on a recurring basis, and then that cushion can fill in the gap on a lower net, call it net amount at risk, if you want to think about it in terms of insurance. But there's always this this study, and I think it came back earlier, not too long ago, that retirement medical expenses in retirement will cost on average $300,000 for a couple. What that number doesn't say is that it may be significantly lower, or it can be significantly higher depending on how long you live. And of course, given the circumstances, I'm not downplaying the circumstances, but if you have more income to absorb at least some of it, that cushion that you put aside can be managed a little better.
Good point. And to some extent, there's a disincentive for earning more money in retirement, because it makes your expenses go up in terms of, say, for your Medicare premiums go up significantly based upon your income. So that's another issue that adds additional complexity.
Fun stuff.
Fun stuff.
Okay,
indeed.
now I love following you guys on LinkedIn. I will admit, I'm more of a lurker. I'll give you likes. I'm a little trepidation sometimes to jump in the discussion. What's the best LinkedIn discussion you've both been involved in here? I mean, David, what's the topic you're like, oh, that was the best discussion?
Well, I'll go with my recency bias concept. There was one this morning. It's talking about, I forget which academic it was that made a presentation at a conference the other day and said, it's really tough for the insurance industry to grapple with the idea of guarantees.
Oh, I got somebody texted me that link and said, "Can you believe this?"
So and then I commented on something Michael Finke said, and my retort was basically, look, there's one singular advantage the life insurance industry can offer: guarantees, right? Lifetime guaranteed income. Why do we take that singular advantage and water it down? Why do we confuse the population, both the public and the advisor population, by moving away from the term in favor of something like protected income, which is hard to define, which is confusing to people, in which advisors shake their heads and say, I can't believe this is happening. it gets down to a communications issue again, which has always plagued the industry, and its inability to express its value. This is just one more, very recent manifestation of that process, I believe.
Bruno, what?
Well, I will simply point down to the That Annuity Show guest list, and all of those conversations on LinkedIn are always a source of knowledge, wealth, and entertainment, to say the least.
Well, let me ask you guys: do you agree with me that we should not back away from the term guaranteed?
Oh, I'm David. I'm squirrely in your corner, and we've listen. The company I'm working for had this great product with some guarantees, early income guarantees, built franchise. Now we've had to diversify, and we've got one of these growth ones, but frankly, I like these guarantees. I hate having to explain, well, index was backcasted and tested, and this is what it did, but guess what? Here's the market went up and down instead of up, and here's what you end up with. I think there's still value, but I agree with you, it confuses people. It sounds like they're getting investments, not insurance, and insurance is the strength of our company. So I'm biased. Ramsey, what do you think? And what are the takeaways here from the discussion here?
So, I look, as a matter of as a factual matter, guaranteed income is what it is, and so I think that's a valuable thing to say. I think we struggle with finding a vocabulary that will keep the lines of communication open, right? Like annuity, forget about that, right? And guaranteed income, people very quickly sort of associate that with annuity. So I think there's a bit of a communications conundrum, over and above the factual underpinning. So David, I basically agree with you on the specific term, but we have to sort of consider marketing implications. And then just a broader comment on guarantees. One of the struggles that we have is that unfortunately humanity doesn't place enough of a value on paying for stability, right? And I find it interesting that that you think about it, like if somebody puts you in the stock market, you may make a lot of money, but that's because of risk you took, not the person that put you in the stock market.
Right.
But there's a premium paid. 1.25% a year is a premium fee on that service if you think about it. And yet there's all this reluctance to pay for stability. So it's a conundrum that unfortunately we bat.
It's the essence of the problem. As I say to the RIAs, you wouldn't get in your car if it was uninsured. You wouldn't dare drive an uninsured car. You would never leave your home uninsured against fire, right? But you'll every day leave your clients and yourself your income uninsured. Yeah. It's craziness.
Yeah. Well, to sort of borrow a little bit from Michelle Richter, one of our other guests, about words and what we do. I'd much rather sell the word will than the word could, right? You could do this. You could get this. Ramsey, you will get this. It may not be as big as this, but you will, as this could be. So there's a lot of power there in the will word. And then, Bruno, it's not an illustration, it's a quote. Quotes, easier to sell, easier to explain. Illustrations.
Absolutely.
Okay.
Absolutely.
All right. Listen, let's see. Okay, David, and I'll put these in the show notes. How do people find out more about the constrained investor, your ideas, and pull some of these great concepts into actual practice?
A couple of ways. Well, certainly there's a book, Constrained Investor, that's available. But if you were just to go to, say, Advisor Perspectives, there's one website where I've written a lot for it. There's a Financial Advisor magazine as well. There's a lot of articles about this. My website, davidmacchia.com. There's a cool download there, an e-booklet I wrote. You don't have to put any information in, you don't have to fill out any forms, just click a button, you can download it. It can be very helpful. Or my company's website is well2k.com. All of that has a lot of great
Okay, great. I'll put those links in the show notes. Bruno, you get this right. I'm sorry. Lifetime Income to Retire with Strength, available on Amazon, correct?
Correct.
Okay. Anywhere else?
Spot on.
Anything else we should point people to recent work, articles, places you've appeared?
To your point, LinkedIn's a great source. The book, David's two books. I think there's a wealth of information and subject for discussion.
Okay, great. All right, Ramsey, Bruno, David, thanks so much for joining us, and thanks to our listeners. Keep the text coming, and some of these people know who you are. And like I say, LinkedIn, listen, share us, follow us, and give us suggestions on who we should have on next. Thanks so much.
Thank you.
Thank you.
Have a great day.